Silver holders, beware. If you own even a single ounce, the next 10 minutes could be the difference between making a fortune and losing everything. The silver market just went through one of the most violent moves in modern history, and what happens in the next few weeks will determine whether you're positioned on the right side of this trade or not. It's Sunday, February 15th, New York time. Drop a comment below with your date and location so I can see where you're watching from around the world. And if you find this analysis valuable, please hit that subscribe button and comment George Williams, because it genuinely helps this channel reach more investors who need to see this information. Right now, as I'm recording this, silver is trading around $83 per ounce. Now, if you haven't been paying attention to silver over the past few weeks, that number might not mean much to you. But here's what you need to understand. Just 3 weeks ago, in late January, silver broke above $110 per ounce for the first time in history. That's right, silver hit an all-time high, smashing through every previous record, and investors were absolutely euphoric. But then something happened that nobody saw coming. The market didn't just pull back, it didn't just correct, it collapsed. We're talking about a nearly 50% crash from the peak in a matter of days. From $110 down to where we are now at 83. That's a 30% drop from the highs, and it left thousands of investors absolutely devastated. Now, before we talk about what's coming next, you need to understand how we got here, because this isn't just some random price movement. When you zoom out and look at the bigger picture, silver is still up approximately 162% compared to where it was a year ago. Let me say that again because it's important. Despite this massive crash, silver has still delivered 162% returns over the past 12 months. That's one of the strongest annual performances we've seen since 1979. So the question everyone's asking is, are we in the middle of a healthy correction in a long-term bull market, or did we just witness the top? And that's exactly what we're going to figure out today. Listen, here's what really happened during that crash. According to U.S. Treasury Secretary Scott Bessent, the extreme volatility was driven primarily by speculative activity, particularly from Chinese traders who were piling into silver with massive amounts of leverage. Now, when prices were rocketing higher, everyone wanted in. Traders were using borrowed money to amplify their positions, and the exchanges were allowing them to control huge amounts of silver with relatively small amounts of capital. But here's the thing. When silver hit those record highs, the CME, which is the Chicago Mercantile Exchange where these futures contracts trade, they got nervous. They looked at the leverage in the system and decided to increase margin requirements from 11% all the way up to 15%. Now, that might not sound like a big deal, but when you're talking about highly leveraged positions, that small change is absolutely massive. It meant that traders who were already stretched thin suddenly had to come up with more cash to maintain their positions. And when they couldn't, they were forced to sell. And when everyone's trying to sell at the same time, that's when you get a forced liquidation event. Prices crater, stop losses get triggered, and it creates this cascading effect where the selling feeds on itself. But now pay attention to this, because this is crucial. While all that speculative drama was playing out, the actual fundamentals of the silver market haven't changed one bit. In fact, they've gotten stronger. The silver market is expected to remain in a supply deficit for the 6th consecutive year in 2026. Let me emphasize that. 6 years in a row where global demand for silver exceeds the amount of silver being mined and produced. The deficit for this year alone is projected to be around 67 million ounces. Now, when you step back and look at the total numbers, the picture becomes even more compelling. Global demand for silver reached an estimated 1.2 billion ounces or more in 2025, while total supply, including mining and recycling, only came in at around 1.03 billion ounces. That's creating a structural deficit of somewhere between 160 to 200 million ounces. Think about that for a second. The world is consuming way more silver than it's producing, and this has been going on for 6 straight years. Eventually, something has to give. Now, where is all this demand coming from? This is where the story gets really interesting. Solar photovoltaic manufacturers consumed over 25% of the entire annual global silver supply in 2024. 25%. That's because every solar panel requires silver for its electrical conductivity, and as the world pushes toward renewable energy, that demand is only accelerating. But it's not just solar. Electric vehicle production drove silver demand up an estimated 20% in 2025. Every EV uses significantly more silver than traditional internal combustion engine vehicles because of all the electronics and electrical systems involved. And then you've got the artificial intelligence boom. AI data centers require massive amounts of silver in their infrastructure, Advanced semiconductors need silver. Consumer electronics across the board are eating up supply. This isn't speculative demand. This is real, physical industrial demand that isn't going away. Here's where it gets even more interesting. Physical investment in silver, meaning people actually buying coins and bars to hold, is forecast to rise by 20% in 2026 to reach a 3-year high of 227 million ounces. Why? Because of elevated geopolitical tensions, concerns over central bank policies, and the independence of the Federal Reserve, and persistent uncertainty surrounding economic policies, particularly in the United States. When people get nervous about the financial system, they buy precious metals. It's been that way for thousands of years, and it's happening again right now. Now, there are some headwinds we need to talk about because I'm not going to sit here and pretend everything is perfectly bullish. Jewelry demand is projected to fall over 9% in 2026, and that's directly because of these record-high prices. When silver gets this expensive, jewelry manufacturers and consumers start to pull back. Industrial fabrication is also forecast to decline about 2% to around 650 million ounces, partly due to what they call silver thrifting in solar panels. Basically, manufacturers are figuring out ways to use less silver per panel because it's gotten so expensive. But here's the thing. Even with those declines, the market is still in a massive deficit. The supply simply isn't there to meet all this demand. So what about the Federal Reserve? Markets are currently pricing in roughly 60 basis points of easing by year-end, meaning interest rate cuts. We've been seeing weaker U.S. economic data, including stalled retail sales in December, and that's shifting expectations toward easier monetary policy. Now, why does that matter for silver? Because when interest rates come down, it makes holding non-yielding assets like silver more attractive. There's less opportunity cost. Plus, rate cuts typically signal economic weakness, which drives safe haven demand. And speaking of safe haven demand, let's talk about gold for a second because it's relevant. Gold is trading around $5,000 per ounce right now. $5,000. That's putting it out of reach for a lot of retail investors who want exposure to precious metals. But silver at $83? That's accessible. Regular people can afford to buy physical silver. They can hold it in their hands. And that accessibility factor is driving a lot of new money into the silver market from investors who feel priced out of gold. Now here's the million-dollar question. Where does silver go from here? And I'm going to give you both sides of this because I want you to make an informed decision. Let's start with the bullish case, and honestly, it's pretty compelling. We've got a structural supply deficit that's continuing into 2026. We've got strong industrial demand from sectors that are only growing, including solar, electric vehicles, and AI infrastructure. We've got a physical market that's extremely tight, with historically low inventories relative to demand. We've got safe haven demand from geopolitical uncertainty and concerns about monetary policy. And we've got the accessibility factor compared to gold. If those fundamentals play out, some analysts are talking about silver potentially retesting the $100 level later this year, or even pushing beyond it if we get the right catalysts. But let me give you the bearish risks because they're real. First, we just saw what happens when too much speculation enters this market. The volatility is extreme. That recent crash spooked a lot of investors, and some of them aren't coming back anytime soon. Second, at these elevated prices, we're seeing demand destruction in certain sectors. Jewelry demand is falling, and industrial users are trying to find substitutes or use less silver. Third, there could still be more speculative unwinding to go. If leveraged traders are still sitting on losing positions, they might need to sell more, which could push prices lower in the short term. And fourth, if the Federal Reserve doesn't cut rates as much as the market expects, or if economic data improves, that could reduce some of the safe haven appeal. From a technical perspective, silver finding support around this $80 to $85 range is actually significant. It suggests the market might be establishing a new floor after the panic selling, but we need to see it hold. If $80 breaks, the next support level could be down around $70 to $75, which would represent an even deeper correction. On the upside, if silver can reclaim the $95 to $100 area, that would be a strong signal that the bull market is back on track. In the short term, meaning the next few weeks, I expect continued volatility. We might see silver bounce around between $75 and $90 as the market tries to find equilibrium after that massive move. But medium term, looking at the rest of 2026, the fundamentals suggest higher prices are likely if that supply deficit continues and industrial demand holds up. The key catalysts to watch are Federal Reserve policy decisions, any major geopolitical events that could drive safe haven demand, solar and EV production numbers, and whether we see any significant new mine supply come online, which honestly seems unlikely. Now, if we look at history, we can get some perspective. Back in 2011, silver spiked to nearly $50 an ounce before crashing. That was driven heavily by speculation and ended badly for a lot of investors. But the difference this time is the industrial demand story is much stronger. Back then, solar wasn't a major factor. Electric vehicles barely existed. AI wasn't driving data center construction. The fundamental demand picture is much more robust now than it was in 2011. And if you go back even further to 1979, silver hit $50 in inflation-adjusted terms, which would be well over $100 today. That was also a speculative bubble, but again, we didn't have the industrial demand drivers we have now. So what should you actually do? Here's my take, and this is not financial advice, but it's what I'm seeing from the data. If you're thinking about entering a silver position or adding to one, the current level around $83 looks more attractive than it did at $110. That's obvious. But given the volatility we just experienced, you need to approach this with caution. Financial advisors typically recommend no more than 10 to 15% of your portfolio in silver, with total precious metals exposure capped at around 20%. And I think that's reasonable guidance. Don't bet the farm on silver, but having some exposure makes sense given the fundamentals. In terms of how to own it, that depends on your goals. If you want physical possession and you're thinking about silver as a long-term store of value or insurance policy, then buying actual coins and bars makes sense. You own it, you control it, nobody can take it away from you. But physical silver has premiums and storage considerations. If you want easier liquidity and you're more interested in trading the price movements, then ETFs or futures might be more appropriate. But you're not actually holding the metal. There are trade-offs either way. What should you be watching in the coming weeks and months? First, monitor the price action around this $80 level. If it holds, that's constructive. If it breaks, be prepared for more downside. Second, pay attention to Federal Reserve communications and any economic data that might influence rate expectations. Third, watch for any news on industrial demand, particularly from the solar and EV sectors. Fourth, keep an eye on physical premiums. If premiums on coins and bars start spiking, that's a sign of tight physical supply, even if paper prices aren't reflecting it. And fifth, watch positioning data on the futures markets. If we see speculators getting overly bullish again, that could set up another volatile move. The bottom line is this. Silver just went through an extraordinary period of volatility, but the fundamental story hasn't changed. We're still in a structural supply deficit. Industrial demand is still strong and growing. Investment demand is still solid. Yes, there are risks. Yes, we could see more volatility. But if you believe in the long-term case for silver, this pullback might be an opportunity rather than a disaster. Just make sure you're sizing your position appropriately and not using leverage. Because as we just saw, leverage can absolutely destroy you in this market. If you found this analysis helpful, please hit that subscribe button right now and drop a comment saying George Williams, so I know you're tracking with me. I'm going to be covering silver and precious metals regularly as this situation develops, and you don't want to miss the next update. The silver market is at a critical juncture right now, and the decisions you make in the next few weeks could have a huge impact on your wealth going forward. Stay informed, stay rational, and I'll see you in the next one.